Welcome to The Explainer. Today, we're going to tear apart a very common estate planning tool that honestly can have absolutely devastating tax consequences if you're not careful. We're talking about the traditional life estate deed. All right, so here's our game plan. First, we're going to look at why these deeds are so popular in the first place. Then, we'll see how a single decision, the decision to sell, springs a massive tax trap. After that, we'll get into the weeds dissecting the specific tax code sections that cause all the pain. We'll also touch on a few other complicating factors, and then finally, we'll talk about how to sidestep this trap entirely. So, first things first, why would anyone use a traditional life estate deed? Well, on the surface, it seems like a brilliant, simple solution.
Think of it this way. A life estate deed literally splits the ownership of a property across time. You've got the parent, who is the life tenant. They get the exclusive right to use and enjoy the property for their entire life. Then you have the children, the remainder men, who get a future interest. They know legally the property is theirs the second the parent passes away. It's two distinct legal estates coexisting on the very same piece of land.
So, why do people do this? Well, the main drivers are almost always about avoiding probate court, which can be slow and expensive, and maybe some Medicaid planning. It looks clean, simple, and cheap. But here's the crucial thing. The focus is almost never on tax efficiency. And that's exactly where the trouble starts. This push for simplicity creates a really rigid ownership structure that can turn into a huge financial nightmare later on. Now, the deed itself isn't really the problem. The trap isn't hiding in the fine print. No, the trap is sprung when life happens, when circumstances change and the family decides they need to sell the property before the parent passes away. And here's the first big surprise for most families. If they sell the house, they don't just get to split the money however they want. Nope. The IRS has very specific rules for this, dictated by Section 7520, which uses actuarial tables and the current interest rates. And the key takeaway is this. The older the parent is, the smaller their legal share of the sale price becomes. It's really a zero-sum game. The children's share is just the other side of that same IRS coin. It's the inverse of the parent's share. So as the parent ages and their life interest value shrinks, the children's remainder interest value automatically grows bigger and bigger. Now, let's plug in some real numbers because this is where you can see the absolutely devastating impact. Okay, this is it. This is the moment the trap snaps shut. Just look at these numbers. The parent, at age 80, only gets about 22% of the proceeds. Now, because they lived there, they can use the Section 121 Home Sale Exclusion and pay zero tax. Fantastic for them. But the children, who didn't live there, get the lion's share of the cash, a whopping $429,000. And here's the killer. They get almost none of the original cost basis. That means no home sale exclusion for them, leaving them with a staggering, brutal taxable gain of $390,000. So what's the final damage? A federal tax bill of nearly $93,000. And let's be crystal clear. This is money that the family loses only because they sold the property during the parent's lifetime. It's a huge and, frankly, completely avoidable loss of family wealth. So how on earth is this even possible, right? Well, the answer is buried in the tax code, in the specific ways the IRS treats a property sale depending on when it happens, during life or at death. This right here is the absolute key. It all comes down to Internal Revenue Code Section 2036. The best way to think about it is like this. The parent has a string tied to the property. Because they kept the right to live in the house, the possession or enjoyment, the law says that for tax purposes, the entire value of that house gets pulled right back into their estate when they die. Now that string we talked about from Section 2036, you actually want it. Having the house pulled back into the estate is a good thing. It's the magic key that unlocks a massive tax benefit under a different section, Section 1014, the famous step-up in basis. This means at death, the property's cost basis resets to whatever it's worth that day, instantly wiping out all the capital gain. But a lifetime sale cuts that string. If the house isn't in the estate at death, that step-up under 1014 is gone. Forever. And if you want the nitty-gritty, the specific rule here is Treasury Regulation 11014-5. It basically says that the property's original super low basis, say $50,000, gets split between the parent and the kids using those same actuarial factors. This is the mechanical part of the trap.
As the parent gets older, more of the sale proceeds are pushed to the children, but only a tiny shifting sliver of that original basis follows. And that's exactly how you get a scenario with $429,000 in cash and only $39,000 in basis to shield it.
And just when you thought it couldn't get any worse, well, it can. The damage from this trap isn't even a fixed number. It can be made so much worse by the interest rate environment and a whole other hidden gift tax problem that most people completely miss.
This is super interesting. That Section 7520 rate, which the IRS updates every month, is a huge variable. Here's the deal. A lower interest rate actually reduces the calculated value of the parent's right to live in the house. This, in turn, forces an even larger percentage of the sale proceeds onto the children, which of course explodes their taxable gain. So in a low interest rate world, this capital gains trap becomes significantly more dangerous.
Okay, so we've covered the capital gains nightmare, but wait, there's more. Let's talk about the hidden gift tax trap, which happens the very day the deed is signed thanks to a special valuation rule called IRC Section 2702.
So there's this other landmine here, governed by IRC Section 2702. The rule basically says that when you give away a future piece of property to family, but keep a piece for yourself now, the piece you kept has to meet certain qualifications. And a simple, plain vanilla life estate, it flunks the test. The result is just brutal. The IRS values the parent's retained life interest at 0 for gift tax purposes. This means the parent is treated as if they gifted the entire value of the house on day one. A $300,000 house instantly becomes a $300,000 taxable gift, which almost certainly means you're filing a gift tax return.
All right, after all that bad news, you're probably wondering, is there any way to avoid this mess? And the answer, thankfully, is yes. In many states, there are far superior legal tools you can use. In states where it's allowed, the hero of this story is often what's called an enhanced life estate deed. Some people call it a ladybird deed. The absolute key difference is that the parent keeps the total power to sell, mortgage, or even just take the property back without asking the kids for permission. For tax law, that retained power means the gift is considered incomplete, and because of that, if the house is sold, 100% of the proceeds go straight to the parent, who can then use their full Section 121 exclusion. The entire capital gains trap is completely avoided. And this chart just lays it all out. The numbers don't lie. Selling during life with a traditional deed is by far the worst financial outcome. You lose nearly $100,000 to completely unnecessary taxes. Using a ladybird deed gives you the flexibility to sell without that massive tax hit. But notice the absolute best result. If the property is held until death, any of these deeds works just fine, resulting in a full step-up in basis and preserving the most wealth for the family. So what's the bottom line here? The traditional life estate deed, usually created for the simple goal of avoiding probate, can lock a family into an ownership structure that can trigger a six-figure tax bill if life throws them a curveball. It's really a powerful lesson in estate planning. The simplest solution for one problem can often create a much bigger, much more expensive problem down the road if you don't consider all the tax consequences from day one.